Hello friends, so welcome to this concept capsule series. Today we are going to discuss yet another important topic, that is money market hedge from the chapter Forex exposure. See, we will understand money market hedge through this question. Okay, the concept I will explain through the numbers. See, an Indian firm is to receive 1 lakh after 1 year. It wants to cover its exposure using MMH, for which it has collected the following data. Interest rate is India given, interest rate in US given, and spot exchange rate is given. Calculate the rupee realization after 1 year if the exposure is hedged using MMH, money market hedge. See, this is the question that is being asked. First, what do you mean by this MMH? What do you mean by MMH? See, very simple. You are transacting in currency market. You have the currency exposure. Very simple. This is, suppose this company is an exporter oriented company and this company has a receivable of 1 lakh. Receivable means, okay, you will have dollar receivable. This is foreign currency receivable, which means after a period of, say you have exported, okay, you are going to receive after a period of 1 year. After 1 year, you are going to receive $1 lakh. Now, what will you do? After 1 year, you will like to sell the dollar and convert it into rupees. Are you all understanding? Because Indian firm, home currency is Indian rupee. Now, it wants to cover its exposure using MMH. Now, very simple. You have dollar receivable. Now, you have dollar receivable and the dollar quotation today, dollar quotes at 40 rupees, which means $1 is equal to 40 is the spot rate given, which means today is 40 rupees, but you don't know what will be the rate after 1 year, which means when you are going to receive this 1 lakh after 1 year, on that date, you don't know what will be the exchange rate. It can fluctuate. Therefore, you are exposed to foreign currency risk. Now, this person, therefore, wants to hedge through money market. Money market is nothing but interest rate market, which means there are two markets here. One is currency market, another is money market. Currency market, he has a transaction exposure amount of rupees 1 lakh receivable. Now this amount, okay, I don't know what will be the realizable amount. Okay, since exchange rate may fluctuate, so I enter into money market or interest rate market and try to hedge my position. Now, how to hedge using the interest rates is a discussion. See, very simple. Now, I'll tell you before that what is the strategy to be used. I'll tell you. Thereafter, we can understand the concept in a better way. Very simple. You have $1 lakh receivable. You have $1 lakh receivable. Tell me, children. Now, if you have $1 lakh receivable, this is foreign currency asset or foreign currency liability. Very simple. This is receivable, asset. So this is foreign currency asset. Now, you have foreign currency asset. What you do, you create a corresponding foreign currency liability, which means here I have, okay, the balance sheet. Suppose this is the balance sheet. Okay, here I have foreign currency asset, FC asset of $1 lakh. Now, what I need to do is that I need to create foreign currency liability to the extent of $1 lakh, to the extent of $1 lakh. Now, to create this foreign currency liability, okay, it should be such a way that it offsets your position on the maturity date, which means today you will borrow, you will deposit, you should borrow. Are you all understanding? You have foreign currency asset. You need to create a foreign currency liability, which means borrow in America, borrow in US dollar. Are you all understanding? So borrow, this is the strategy I need to apply. Money market hedge. What is the strategy? Borrow $1 lakh. Okay, this is not 1 lakh. What you should do, I'll tell you. You should borrow such amount that it will become 1 lakh after 1 year, which means present value of this exposure amount, present value of $1 lakh, you will borrow today, okay, so that it matures to 1 lakh after a period of 1 year, so that this foreign currency liability exactly offsets your foreign currency asset. This is the thing. Very simple. Why we are borrowing? What is the agenda? Everything we are going to see in 1 minute. Very simple. See here. So, present value of 1 lakh. Now, you need to discount this 1 lakh. At what rate you need to discount? 5%. The interest rate prevailing in the US, you should consider up 1 divided by 1.05. Take your calculator. 1 divided by 1.05 into, okay, 1 lakh. How much is that? 95,238. Okay, 1 divided by 1.05 into 1 lakh is equal to 95,238. This amount, okay, I will borrow from the US. Are you all understanding? So, first step in the money market hedge, step by step we will understand. Step 1 is to, okay, see whether it is foreign currency asset or liability. This is export oriented question, so which means the firm has $1 lakh receivable, okay, which means he has foreign currency asset. You need to create a foreign currency corresponding liability, which means you need to borrow or deposit a borrow. You create liability in a borrow. Now, how much you need to borrow? Only present value of this you need to borrow. If foreign currency asset, then create foreign currency liability, okay, or borrow foreign currency. If foreign currency liability is there, then create foreign currency asset, that is deposit in the foreign country. Now, steps for money market hedge. First step, okay, what you should do? You should borrow today. How much you need to borrow? Present value of this exposure amount. Present value of this exposure amount you will buy. $95,238 you will borrow. Convert at spot rate. Convert this dollar. You have borrowed in the foreign country. Now you convert. What do you do? When you do this today, spot na. So convert this using spot rate. Convert this using spot rate. 40 rupees. Are you all understanding? So 95,238 into 40 rupees. How much is that? Okay, 38 lakh 9,520. 38 lakh 9,520. If I convert this, how much I'll get? Rupees 38 lakhs 9,520. Next, what is the step? I go and deposit in the local bank, Indian bank. I converted it in Indian rupees. Now it is INR. I go and deposit in Indian bank. What is the interest rate given? 10%. I deposit. The third step is deposit at INR deposit rate. INR deposit rate, which is 10% in this case. Are you all understanding? This happens today. Now these transactions happen today. Now you see, on the date of maturity or at maturity, what happens? Very simple. Okay, this deposit you made to the extent of 38 lakh 9,520, this will be maturing. Okay, at 10%, if you add a 10% interest, what will be the total maturity value? 38 lakh, okay, 9,520 into 110%. How much is that? 41 lakh 90,472, rounding off. Okay, 41 lakh 90,000. Roughly it should be 41 lakh 90,000. Anyway, now what happens? See what happens on the date of maturity, that is after 1 year. The maturity value of foreign currency borrowing will exactly offset the foreign currency receivable. Very simple. What you did initially, this was the balance sheet. You have receivable of $1 lakh na. You have receivable of $1 lakh. Here you created a foreign currency liability, which means you borrowed how much? 95,238. Okay, this after 1 year, what happened? Okay, plus 5% interest rate. It matured to how much? $1 lakh. After 1 year, this 1 lakh liability and asset gets cancelled. Then what is remaining, sir? What is this concept all about? Very simple. What happened? This 1 lakh and this 1 lakh get cancelled. Effectively, what happened? Today you borrowed 95,238 and converted into 38 lakh 9,238 or 38 lakh 9,520. This 520 you deposit. This is INR and you deposited at 10% interest rate. This matured to 41 lakh 90,000. Are you all understanding? This 41 lakh 90,000 ultimately will become your receivable amount in terms of rupees. Which means very simple. Earlier you had, if you don't go for hedging and leave your exposure open, what happened initially? $1 lakh receivable was there. You don't know what would be the exchange rate prevailing on the after 1 year, which means you are exposed to foreign currency risk. Now, beautiful thing, what happened now? See, you used a 5% interest rate. Okay, you know that. Okay, if you borrow 95,238 today, 95,238 in foreign country in USD, okay, after 1 year it will mature to 1 lakh. This is certain. Why? Because you are locking in interest rate. You are borrowing at a specified interest rate of 5% in the foreign country, which is specified and it is absolutely sure. Are you all understanding? So 1 lakh is a certain amount to be received after 1 year. To be received in the sense to be the maturity value of the borrowing after 1 year. This is also certain. 1 lakh receivable after 1 year. $1 lakh is certain. I don't know rupee value of the dollar, but dollar 1 lakh is certain. This is also certain. This is also certain. So these two gets cancelled. And when I convert using spot rate, that is also certain, which means I convert today or tomorrow or today itself I converted to 38 lakh 9,520. That is also certain. And I deposited 10%. The 10% I lock in Indian rupee. Okay, deposit rate, that is also certain. Hence the maturity value of 41 lakh 90,000 I will receive from local Indian bank. This is also certain. Effectively, I converted the $1 lakh into 41 lakh 90,000 today itself. Hence I am not exposed to currency risk. Are you all understanding? Okay, one of the beautiful way to hedge the currency exposure is money market hedge. Every attempt, mostly, okay, if you see in the Forex, they ask the money market hedge concept along with the forward contract. They ask you to compare the forward with money market or futures, currency futures or currency option. So most probably, okay, hedging based question, money market hedging is one of the most important topic. Okay, I hope you all understood the concept. Okay, therefore the net realizable value, calculate the rupee realization. You tell me what is the rupee realization? 41 lakh 90,000 ultimately the 41 lakh rounding off ish 41 lakh 90,000 will be the rupee realization value. Are you all understanding? If you like our videos, okay, please subscribe to our channel, keep the bell notification on. Thank you.